Good morning, it's Jeffrey Cohen, U.S. Advanced Computing Infrastructures, Inc., also known as Chicago Quantum. I'm the president and investment advisor representative here in Illinois. We're a Highland Park, Illinois registered investment advisor. So we're going to talk today about a clever thought that we had, which is the FEDPUT has become a federal put. And what does that mean? That means we've been watching the Federal Reserve act like a support for the stock market, and now we're seeing the overall federal government get in the game of pumping up wealth, pumping up the stock market, pumping up companies, and honestly, we're a bit surprised given all the rhetoric in Washington that this is happening. So let's talk about our model run. Let's talk about the fact that the market is risk off. And then let's talk about FEDPUT, federal put. So this is the run. So if you were to buy a run, you would get this. You'd get your, the report, you get the spreadsheet. And so in this case, we made a few changes last night for the run. It actually took a while. It took a little longer to calculate, computationally a little more aggressive last night. So basically it runs the data through market close yesterday. The variance of the S&P 500 is down slightly. It continues to fall. We have plateaued and now we're coming down. So what does that mean? It means a little less risky to put your money overall in the S&P 500. Doesn't mean it's good. The S&P 500 is down 9.56% versus a year ago, and the other indices are down as well. So if you're looking at your brokerage statement, you probably lost money. And if you went long a bunch of stocks, you probably lost money. We lost money. Lots of people lost money on a personal basis. My wife lost money. 529s are down. Everything's down. But today versus a week ago, the risk of putting your money back in the S&P 500 is a tiny bit lower. That's good. So we made a change. The risk-free return in our market, in the stock market, and basically putting your money in treasuries, putting your money in bills, putting your money in CDs, that interest rate dropped back to 4.7. So that makes it a little less attractive to put your money in risk-free assets. So you probably should have done it earlier this week when we said to, because it's down a little bit now. That's okay. So there's 3,402 stocks that traded yesterday, that have traded 10,000 shares or more over the past year, that are listed in U.S. stock exchanges, that are U.S. common stocks, that have a positive beta. There's a bunch of these data validation points that had valid data points, valid prices and volumes and things over the past year. The overall stock variance is staying about flat for all the stocks. So we've talked about before how a couple of stocks outperformed the market, and we're down to two of them. So what this means is if you were to look at all 3,402 stocks, only two stocks have a negative CQ&S score or are better than the stock market in terms of risk-return trade-off, and that's P&M Resources. For those who've tuned into the show, you know that is the New Mexico regulated public utility, and it's up 600% since the global financial crisis, and it's the sleepiest stock you ever saw. And there's Berkshire Hathaway. I'm not going to say I'm surprised to see Berkshire Hathaway as a good stock. Risk return, it's very attractive. It's like buying a mutual fund because it's an insurance company that buys other companies and diversifies. So you're really buying a holding company, you're really buying an investment company, you're really buying an ETF when you buy Berkshire Hathaway. So it's a little not fair. So you're back down to one stock. P&M Resources. That's interesting, right? Now, with the other stocks that are attractive are your risk-off type of stocks. Coca-Cola, Accenture, Pepsi, Honeywell, Mondelez, ADP, Johnson & Johnson, Otis, elevators. You know, what goes up must come down, right? Okay, sorry, bad joke. But point is, it's risk-off stocks. Now, the worst stocks are stocks, in general, most of these stocks are tiny. I looked, some of these stocks actually have less than $1 million market cap or less than 10 million market cap. They're just crazy, right? So putting your money in those are just crazy. Now, you can see lots of stock with low volume compared to a year ago. These are stocks that have traded under 10% of their average shares that they traded over a year. And then there's stocks that have huge volumes. Look at that. 787% of average trading volume or higher. The banks have been discovered. I have to say, emotionally speaking, I am in turmoil because I was early. So I did all this analysis on the banks. I made a video. I wrote Medium articles. I told people, right? If you were a client of mine, I told you, banks gonna fall, especially the ones with really high valuations. And I have a list of them. And unfortunately, some of those banks with the really high valuations are the ones that have fallen the fastest. And we had short positions, we had put positions. My family was sick of hearing about how the banks are going to crash. Well, they crashed. Unfortunately, I was early, so I made all my short plays and my put plays, and now I don't have any of those plays. And so I'm just watching the banks fail and fall without any benefit, which is fine, but I did all the research. Bank of Marin Bancorp, I did all the research. Cullen Frost, no benefit, right? So now I'm rooting for the banks to basically stay solvent. But about 3 months ago, I was, Bank of Hawaii. I had a conversation with a guy about Bank of Hawaii. I had puts on it. I was early. So the problem with stock market analysis is you can usually get the fundamentals right or you can get the timing right, but you can't get both. So very frustrated. I got a lot of pain about that. And so just know it's true. All right. So we're going to go into now risk off. I'm glad I shared that. I got that off my chest for you. So I ran a lot of solvers. I ran it deeper. And I'm glad I did because the genetic algorithm at the end ended up finding a slightly better portfolio. So there's positive skew stocks, 44 of them. There's negative skew stocks, 31 of them. And these are highly skewed. There's leptokurtic and low variance. Buyer beware. It means that these stocks really can move. And some of them really, really can move. In fact, one of them was a bank, and it's now dropped off the list because it already crashed, right? It happens. Platykurtic and low variance is risk off. So you're in a good place maybe with some of these stocks, like Otis, the elevator company. So our model likes that, right? Johnson & Johnson, Honeywell, platykurtic, flat tail, thin tail, not a lot of outliers expected moving forward. Little safer. I don't know, you like that. Maybe I like that. Yum Brands, little safer, right? So that's okay. That's fine. That's inside baseball. But the best portfolio is 65 stocks. So that is risk off. Risk off is 65 stocks. To get a tiny edge, 7.1 times 10 to the negative 5 edge. It's still an edge, but you got to hold a bunch of crap in there, like Tesla, and Amazon, and Adobe, and ADP, and AppV, and Apple, Johnson & Johnson, and Pepsi, and Pfizer. You might as well hold the S&P 500 and call it a day. This will slightly outperform. And I've noticed some of the stocks that are anomalous that paid really large dividends slightly more than a year ago have dropped off the list. But it's saying things like Lockheed Martin and Coca-Cola and Eli Lilly and Meta and Merck and Microsoft. So you've got stocks in here. T. Rowe Price, Texas Instruments, UPS. You might as well buy the S&P 500. It's crazy, right? I mean, that's what risk-off looks like. It's painful, actually. It's painful. The worst performing stocks in this market, it doesn't mean they're going to go down, by the way. It just means they're going to move. They're volatile, right? Some people like volatility. Some people need it for their rush, right? Not me. But Atlas Lithium Corp, Com Sovereign, these are big value stocks with big moves, right? And then you got tiny stocks that are worth $1 million, 3 of them, or less. Corbis under 10 million. You know, for a long time ago, they had like $100 million in the bank. So that's worth $10 million. What do they have, 10 million in the bank? It's crazy. Lots of small caps, tiny, tiny small caps. And so that's okay. You want to play the small cap game. If the market were to recover, these stocks would scream higher. So in a way, our worst performers could become our best performers if there's a market recovery. But where the market is right now, you want to play it safe according to the Chicago Quantum Net Score model. So that's fine. So there you have it. So what is this about the Fed put versus the federal put? And Jeff, are you just trying to be clever, or is there something here? And I think there's something here. I like to be clever, it's true, but that's not what this is. So, Fed put, federal put. You know, before I do that, though, just a note, I hope you like following our show. We are U.S. Advanced Computing Infrastructures, Inc., technology consultant and registered investment advisor here in Highland Park, Illinois. And we offer advisory services, right? Stock up, stocks down, daily run. These are daily analyses. You can give us your stocks, or you can let us look at all 3,400 stocks. We also offer project services and custom services, and we'll manage money. And we do a lot of publishing of blogs and Medium posts and all that. But the way we make money is we run analyses. And for paying clients, we give it to you the night before. And in many cases, if we have a paying client that day, we won't share publicly our picks. So you get a bit of an exclusive. If there's a couple you buying it, then a couple you get it. It's good. So that's who we are. So what do you mean by a Fed put and federal put? So if you look at our market data, so this is FINRA. FINRA is who regulates us. FINRA runs an analysis using TRACE, which is how bond trades are tracked. And you can see that yesterday, advancers outpaced decliners. So corporate bonds went up in price, which means effectively their yield, or what they have to pay in interest, went down. Okay, so that's great. Why did that happen? It happened because Treasury bond yields at the 10-year have dropped. So the 10-year Treasury note was touching 4%, and it looked like it was going to go higher. It was 4.06, and it has dropped down to like 3.6. So it's dropped down almost a full percent, or full 0.5%. 0.4 or 0.5%. That's a big drop for Treasury notes. So that means people have a flight to quality. People are rushing in to put their money into safety. They're moving into risk off. The market went risk off. Okay. But the problem is that the first people who rushed out of the door got the 4%. So when we were screaming risk off, risk off, risk off, people got the 4%. Maybe a little more even. Now you're getting 3.6. Well, you lost 0.5%. I'm really sorry about that. You're a little late to the party, right? And if you look at short-term money, and I don't mean to be flippant about it, but you're a little late to the party, right? So short-term money, you really were getting 4.7 when we were screaming. Now you're getting 4.5. It's still good, but it's a little less, right? I mean, the market went risk off, and people were not throwing their money into treasuries. And so it's just interesting, right? So the Fed was allowing things to tighten because things looked okay. And that's the time to pull some money off the table, take some chips off the table and put them into some treasury bills, even for 13 weeks, and just wait it out, right? Maybe the market will be lower, maybe things will happen. And so what happened, right? So let's see if I could find a very simple article, right? So this is bank failure. And what do we want to say? Depositor guarantee. So there's FDIC insurance, but really what happened is, and this is just CBS News. This is not what I would call an aggressive news source. This is about the most boring news source there is, right? U.S. government, now notice they're not saying Federal Reserve. U.S. government steps in to shore up deposits at Silicon Valley Bank and another failed banking, basically Signature Bank of New York. All deposit accounts will be guaranteed. Now, FDIC insurance is $250,000 per depositor, per institution. But all of them. Depositors with SVB. So SVB is the 15th largest bank. SVB is a huge bank, right? Like a big, it's not Citibank, but it's not Cullen Frost, who's 50. It's big, right? We are also announcing a similar systematic risk exception for a New York bank. State-chartered New York bank. Not federal chartered, New York chartered. All depositors made whole. So what I love, right? As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer. But that is not correct. Because who's giving the guarantee is the taxpayer. The Federal Reserve, Department of the Treasury, and the FDIC Insurance Corporation. President Biden is making the guarantee, which means President Biden is guaranteeing it, which means they will do whatever it takes. So it's fine, right? Signature Bank has $88 billion, and SIVB, has more. So a new bank term funding program. Additional funding available. So what happened is, boom, and we're going to go take a look at what that looks like. Okay, so the market's not open yet. And what I may do is stop the video as the market opens and then come back in a little bit. But I want to look at the S&P 500 and I want to show you what a Fed put looks like. And don't look at holdings because those are not holdings. That's just some analysis. That's not holdings. Okay, there you go. So we're going to take a look at what I don't know that I like this chart. Let's find a good, there you go. So, Monday's the 13th, okay? So what happened was the market was swimming higher. Okay, it's at 41, almost 4,200. Things are looking good. They had been kind of choppy, right? And we had called risk off, risk off, risk off. And basically, as we're moving into risk off, what happened was the market popped up higher right here. You can see the trend. It went up. And our model did not like it during the sell-off because volatility had started to increase at the individual stock level. The S&P 500 looked fine. S&P 500 is looking less risky. That means that the S&P 500 or the overall basket of diversified stocks looks better. I want you to think about that for a minute. The overall stock market, the overall market is starting to chop up and down, and the amplitudes, the wave is smaller. Look at the size of that wave, right? 4,600 to 3,700, right? Or whatever. It's like 750 points down. This wave down is 4,300 to 4,600 is 700 points. This wave down is 4,100 to 3,800 is 300 points. This wave down is 4,150 to 3,950 is 200 points. So when the amplitude gets smaller and smaller, less risk. Okay. Hey, Jeff, that's great. So I sleep a little better at night if I put my money in the S&P 500. If I put or in any proxy of that, right? It's a diversified portfolio. So that's better. That's risk off. Put your money in a diversified fund. Sleep at night. Quit trying to time the market, right? And so what happened was the Fed stepped in. Now, what is that? Jeffrey, what does that mean, the Fed stepped in? So they came out on Friday. So on the 10th, you see the market dropped. Boom. It was a bad day on the 10th. It really was a bad day, right? It was a crap day. It's fine. Came down to like 38.60. So the federal government comes out and says, we will guarantee all investors, everyone's fine, don't worry. Now, there's things called moral hazard, which means the banks have been bailed out. So SIVB Bank had a stock that was so volatile and so highly valued that I would try to buy puts, but it would have to fall by like $30 a share or 10% for me to make money on my puts. So I couldn't buy the puts. They were so expensive, right? Because the stock was risky. Bank was making money being risky. That's not how banks are supposed to be, right? And so when he stepped in, so you go to the market I remember overnight, the market screams higher to like 4,000 again or 3,950. That is a federal put. Not a Fed put, but a federal put. This is when President Biden says, I'm going to make all depositors whole. I'm really sorry that the bank had a bad day, and we're just going to make everyone okay. Now, I understand logically why you would do that. You're the President of the United States. It's not your money. It's a taxpayer's money. It's my daughter's money. And he doesn't care. Because what he cares about is getting reelected and his party getting reelected. He cares about the American people as well. Let's be honest. A lifetime of service. It's fine. But really, he doesn't care about the money. Build back better. $3 trillion. Whatever. I don't care. Money, money, money. Inflation, inflation, inflation. It's fake money at this point to them. But what he does care about is lines of people at the banks pulling their money out. He cares about people fired from startups. He cares about innovation being destroyed in the United States because the private equity and venture cap companies lost access to their funds while they wait for SVB Bank or Silicon Valley Bank and a host of other banks probably to make good. And so market crashes, market soars higher, still dropped on Monday because no one really believed that this made a good sense, right? The banks just crashed, right? But the market came back. And the market recovered. Actually, I was watching. The banks were down, but the market pretty much recovered. And it's a federal put. It's the U.S. government stepping in to guarantee depositors. Now, they're saying it's only 2 banks, but let's be honest. They'll guarantee all of them. So what does that mean as an investor? So what it means is you go over to FinViz, which I love, financial visualizations. You go to the futures. You scroll down to U.S. dollar currency, and you see that the U.S. dollar was making a nice little comeback there. It was like 106, and now it's 103. So the U.S. dollar lost 3%. 3% of your spending power, people. Gone. Because Biden and his cronies decided to bail out the banks and bail out investors and bail out depositors and bail out everyone. And it actually doesn't even matter, right? He's just going to print money to the extent is necessary. It's just... So what? But the good news is... So where's the good news? Where's the silver lining, Jeffrey? The silver lining is dollar falls. Assets start to inflate. Now, you notice oil is down. Copper is down, but flat. The VIX is starting to recover. But you're going to see assets go up because the dollar's weaker. Now, gold and silver are down, so there may be a little lag. But the way we see it, a falling dollar and an open Fed checkbook means more inflation. More inflation. And that means rising assets. So, I want to thank you for watching. If you like the video, we're not paid to make the video. Come check out the website. We publish this stuff for you. Buy a run, a daily run. I'll get it to you. Then my phone is open. You can call me anytime. We can talk about stuff. When we do a bank analysis, I'm happy to share it with you if you're a paying client. And thanks for watching. You take care now. Good luck out there. Bye-bye.